This should be the top story in my opinion. This should not be like the seventh thing up there. I've never met anybody in real life that even has more than 100K on a Tesla. This is definitely the most, in terms of real life, like somebody I met that had the most miles on it. And you know what he told me? He said he's never had to replace anything major in that car. Overall, today definitely has a Santa Claus rally feeling behind it. I'll just be honest with you guys. Ho, 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 Merry Christmas. Howdy, folks. Hello, chat. So I was laughing earlier because they were talking about some Wall Street, or I don't know if it was a Goldman Sachs person or who it was, but they were talking about, they had just put out their S&P price target for 2024 last month, and now they put it out at, I think it was 4,700, and now they already upped it to 5,100 just like that. And it just goes to show you, you know, how fast these Wall Streeters can kind of all of a sudden change with the market, right? By the way, Tesla. So spoke to a guy yesterday. This is pretty crazy. Spoke to a guy yesterday, and wait a minute, I need to find my thing here. Where's it at? Saw him at the track, and it was interesting. He said that, well, he was talking about my car. We both got done around the same time, and he was looking at the Model X and asking some questions about it. And then I was like, I had a little trouble telling if his car was a 3 or an S. And he's like, oh yeah, it's an S. And he's telling me he got it in 2014, and he drives between Canada and Vegas and back all the time. I didn't ask him what for, but he always driving from Canada to Vegas, Canada to Vegas. And so he's got 235,000 miles on his Model S. I've never met anybody in real life that even has more than 100K on a Tesla. This is definitely the most, in terms of real life, like somebody I met that had the most miles on it. And you know what he told me? He said he's never had to replace anything major in that car, which I thought that was great. Being not only a Tesla shareholder, but also really, a Tesla customer over the years. Like, I was very pleased to hear he has never had to do any major work. He hasn't had to have the batteries replaced or anything major with the car, despite having well over 200,000 miles on it. Now, the other thing he was telling me is Tesla obviously sent out a text and email to their customers. I think it was a few weeks ago now at this point in time, where if they upgrade to a new model, they get free supercharging for life. And he said he was considering that. And I told him, yeah, you should consider that. Do the math on it. Because if you're driving between Canada and Vegas all the time, and I don't know what part of Canada he was, drives from or whatever, but still, like, regardless of where you're coming from in Canada, it's a long drive. And you got to supercharge, a lot of times on that drive. And I was like, you should do the math around that, because it might be worthwhile for him to do that. Because, if you got to pay for supercharging to get back up to Canada, that's a lot of supercharging. So, but anyways, really, really was pleased to hear that he hasn't had any major issues, despite having over 200,000 miles on it. I was very pleased about that. Good question. I'll pause this for a minute because somebody said most new vehicles are good for 200,000 miles now. Yeah, one of the big worries with Tesla specific is what happens as those vehicles age, because they're a relatively new automaker. So a lot of people haven't really been able to test them, at least the masses, haven't really been able to test them to 100,000 miles, 200,000 miles, 200,000 plus, right? And so it's nice to be able to have some of these tests done, like people actually use them in real life, and to see what the results are. Because that's been a big worry, like, well, what happens? You're going to have to replace the battery at 70,000 miles or 100,000 miles or this or that, right? That's been a worry for a while. Okay, so let's go back. AI-related stocks, Palantir is the worst of the bunch here today. Amazon's the best, followed by Meta, followed by NVIDIA. Let's take a look. And by the way, Meta. Ooh, what a nice chart. What a nice chart you have, Meta. I love that. I absolutely love that. So since Meta's IPO, it's returned 1,000%. What's interesting is if you waited on Meta's IPO until about 4 months later, you would actually be up about 2,000% on Meta. But obviously very good performance over the years there. But yeah, look at that year to date. Woo-wee! 176%. Looks like Meta is going to close at a new high here today, folks. It looks like it will close at a new high. Wow. What a year. What a change. The difference a year can make is unbelievable, really. Wow, KRE's down quite a bit here today. Down almost 2%. That's a regional bank index. Interesting to see that baby down. Big tech, mostly green here today. Wow, Apple's a rare worst stock of big tech here today. Looks like Netflix is the best stock of big tech. Slightly beating out Amazon, slightly beating out Meta and Nvidia. Tesla's second worst stock of big tech here today, down about 0.75%. Overall, today definitely has a Santa Claus rally feeling behind it. I'll just be honest with you guys. Apple makes surprise decision to pause some Apple Watch sales before Christmas over patent dispute. So there's got to be something significant there. For Apple to pause some watch sales before Christmas, there's something there. I'll put it like that, right? So anyways, Nikola founder got 4 years for the fraud. Interesting. Global supply chain under threat after militant attacks in Red Sea. Gosh, we do not need supply chain problems again. Remember why we had the sky-high inflation. Supply chain add on with a commodity super bull cycle we hadn't really seen. And, yeah. So this isn't the type of stuff we want to see, folks. I'll just put it like that. What? Adobe and Figma are going to call... What? No. Adobe and Figma call off $20 billion acquisition. Wow. After regulatory scrutiny? This should be the top story in my opinion. This should not be like the seventh thing up there. Adobe and Figma, the cloud-based design tool, will terminate their planned merger in light of regulatory hurdles. Wow. And Adobe's going to have to pay Figma $1 billion breakup fee. Oh, that sucks for them. Adobe and Figma strongly disagree with recent regulatory findings, but we believe it is our respective best interest to move forward independently. Wow. While Adobe and Figma shared a vision to jointly redefine the future of creativity and productivity, we continue to be well positioned to capitalize on our massive market opportunity and mission to change the world through personalized digital experiences. Dang. I want to pull up Adobe stock back in September 2020 versus today. Man, that's crazy. That's crazy, man. Now, like I told you guys, there was always a potential that might not go through. And seems, if anything, shareholders might be liking it versus not. Let's go 5 year and then we'll go from there. So let's see, September 2020. So it looks like September 2020, the stock was 480-ish. And today the stock's about 600, we can call it. So interesting. It's also interesting. Adobe still hasn't hit a new high. And it still hasn't hit a new 2020, where it was at in 2021. And if we check out Adobe's net income over the years, Adobe net income over time. Whoa, how did they put up that quarter? 2.2? A little strange. But anyways, back in 2021, when they actually hit that all-time high of nearly 700 or around 700, they were doing about $1.2 billion a quarter in net income versus now they're getting close to $1.5 billion a quarter in net income. So, yeah. Obviously, the business is in a lot stronger position now than maybe they were back in 2021, but you get the stocks lower. Now that's something attractive. That's something I do like. Man, what a move for Adobe though since those lows back in late 2022. 276. It's a double up basically, or over a double up. Man, interesting. So I mean, the good thing for Adobe though is their balance sheet is going to be stronger than ever because now they're not going to have to get rid of well, they were gonna get rid of a ton of cash, and they were gonna dilute shareholder value, from my understanding. So, and I don't know if this is the most updated numbers. I'm assuming it is, but so about $7.8 billion in cash and short-term investments. Total current assets over $11 billion. Total assets about $30 billion. About almost $13 billion of that is made up by goodwill, which they do deserve a lot of goodwill, to be fair. Total current liabilities 8.2, so that's 8.2 versus 11. So their current ratio is not very impressive. Total liabilities 13 versus about 30, so that's pretty impressive. Long-term debt 3.6, so that if they really want, they could pay that down tomorrow and still have plenty of cash around. And let's say they're bringing in $6 billion. Let's say over the next few years they bring in $6 billion to $8 billion a year in net income. That cash stack should get a lot bigger. So, anyways, interesting, really interesting in regards to that. Fed's Goolsbee says he was confused by last week's market reaction. The Fed voted last week to hold rates steady once again. In its updated projections showed an expectation of 3 rate cuts in 2024. However, the Fed President Austin Goolsbee said on CNBC's Squawk Box on Monday that his reaction wasn't fully the reaction wasn't fully rational given what the central bank actually said. It's not what you say or what the chair says, it's what did they hear and what did they want to hear, he says. I was confused a bit. Was the market just inputting? Here's what we wanted them to be saying. That's funny.
With a special guest who happens also to be known as Mr. President, Steve.
Yes, Joe, we're going to have to talk about the title situation in just a few minutes. But joining us right now is Chicago Fed Mr. President Austin Goolsbee. Austin, thanks for joining us this morning.
Thanks, Steve. It's only Joe that has to call me Mr. President. Please just call me Austin.
Okay. All right, we'll get to that. I'll call you Austin for
That's
that.
actually kind of funny.
Goolsbee. Austin, I wonder if it would be useful just to start off to create a baseline here. How do you explain to folks, how would you explain to the market what you all did on Wednesday? What was the change in policy as you understand it?
Well, as you know, I don't
North
speak
Korea
for the
fired a
committee.
missile?
Every member of the
Gosh.
FOMC just speaks for themselves. I thought that we were voting on that meeting, and we voted not to raise rates. We put out, as we do each quarter, a statement of economic projections, which each of the individual members says what do they anticipate the conditions will be over the coming year and beyond. So the policy change was no change. We kept the rates where they were. I think we reflected, and in my mind, I see that the data on inflation, which I've highlighted on this program with you, Steve, over and over again, is the key thing where we've missed on our mandate, and the key thing that should drive our decision making is on inflation, and we've seen significant improvement on the inflation front, bringing us back closer to what looks like to our target. And I think that that's reflected in the SEP dots, if you want to think of it that way.
When you put the word any into the statement to talk about additional policy firming or tightening, what is that telling you? Is that telling you that all of a sudden there is no longer a bias to hike, or is there still this bias to hike for the committee?
Well, like I say, I don't speak for anybody on the committee. For me, I believe that if we get improvement on inflation, that we're clearly moving to target, and we're still not there yet. We still need to see these markers. But if we get inflation back into the range of our dual mandate goals, then we've got more symmetric concerns, let's call it, about both sides of the dual mandate.
The reason I'm asking this question, Austin, about what happened last week is because I want to ask you the question about what the market heard. And you guys, it looks like on average, on a median forecast, 3 rate cuts. Somehow the market heard 5 or 6. You said, I don't know when this is going to happen. The market said, for sure in March. How do you react to how the market reacted to what you all did last week?
Well, look, I like your phrase, but it's not what you say or what the chair says. It's what do they hear and what do they want to hear.
Right.
I was confused a bit with was the market just imputing, here's what we want them to be saying? I thought there seemed to be some confusion about how the FOMC even works. We don't debate specific policies speculatively about the future. We vote on that meeting, and we voted at that meeting not to raise rates. We put out an SEP that forecast over next year that the individuals on the FOMC collectively thought conditions are going to not be a recession and inflation is going to be coming down, which would allow us to reduce the restrictiveness. And it's far be it from me to get into the head of what the market is.
Right.
I think we'd be best to remember the old Volcker lesson that our job is to act and their job is to react. If we get into one of these circular, well, let's choose our action based on how we think they're going to react to us saying what they would. I think we're going to get mixed up.
So he's upset. That's the best way I'd put it. He is upset, basically with how the market reacted. And I wouldn't be surprised if he's the only one, not only the only one at the Fed upset.
By owning some consumer staples that had really sort of been bouncing around the bottom, just given the higher rates.
Why is 2024 going to be the year for energy again?
We really like energy. Again, if we're seeing the broadening out and the economy is really going to continue to grow just at a slower pace than we saw in 2023, then energy should continue to do well. We saw, crude oil hit low, like a 5-month low, recently, but it's starting to bounce back a little bit, and we should continue to see that as the supply-demand dynamics favor lower supply and higher prices.
All right, Ayako Yoshioka, I appreciate it very much. Have a great holiday season. We'll see you on the other side of the new year, I'm sure.
What was your name?
To Apple, Steve Kovac. So I've got every mega cap in front of me is up, and up quite nicely today. And Apple's sticking out like a sore thumb. What's happening?
Yeah, hopefully you don't want an Apple Watch for Christmas because you're not going to be able to buy one unless you go out right now. Apple is pausing sales.
Go out right now, get one.
Watches. That's the Apple Watch Series 9, Apple Watch Ultra 2. Those are the 2 top models, the ones that came out just in September. And this is all because, Scott, it lost a patent case against a health tech company called Massimo. This is all over the sensor on the latest Apple Watches that can read your blood oxygen levels. Massimo went through the whole process with the International Trade Commission that ruled an import ban on these devices, saying it violates that blood oxygen patents that Massimo owns. Import ban means, of course, those Apple Watches are made overseas. Therefore, Apple won't be able to import them and bring them and sell them in the United States. So let me give you a couple of dates here. December 21st is the last day to buy one of these watches online, and then Christmas Eve, end of day, December 24th, is your last chance to buy one in stores. Now, there could be a rescue here from the Biden administration.
Sounds like a sales
Christmas
tactic to
Day,
me.
it has to rule whether or not to uphold the ITC ruling or overturn it. If that happens, Apple can start selling the watches again, no problem. But if the Biden administration doesn't, then that pause is going to continue. No of those top tier, most expensive Apple Watch models for sale in the United States, and a big dent to the wearables business. And I'll just point out that Joe Kiani, who's the Massimo CEO, he's going to be on Closing Bell Overtime here with John and Morgan in just a couple minutes talking through this, Scott.
Oh, interesting.
Oh, I'd be
Not
interested
really
to hear that.
expecting a huge material impact on earnings, are we?
No, I mean, it is available until Christmas Eve, so, there might be a little bit of an impact for this Q1 holiday quarter, but keep in mind, this is also the quarter, Scott, that Apple is trying to prove at least it can return to that top top-line revenue growth. It needs wearables, not just the iPhone, as part of that picture. Apple likes to say only about a quarter of iPhone owners have an Apple Watch, so they see a huge room to grow the Apple Watch market. But the United States, one of the most important markets for the Apple Watch, maybe the most important. They can still sell the lighter versions called the Apple Watch SE. Has some stripped-down features. It's a lot cheaper. It doesn't have the blood oxygen sensor, so that will still be available. But as far as the latest and greatest Apple Watches, it's unclear when Apple's going to be able to sell them in the United States again, Scott.
Appreciate it, Steve. Thank you, Steve Kovacs. To fight or not to fight, Christina, I guess Adobe and Figma say it's not worth it.
Exactly. Not worth it right now. And well, but you have to think of it too, like a $20 billion that now could be spent on share buybacks for Adobe. So that seems to be the positive consensus right now from street commentary. Even if both Adobe and cloud-based tool design firm Figma, like you mentioned, Scott, just now, both, quote, strongly disagree with the recent regulatory findings. This, according to an Adobe CEO statement today. Why did this happen? We know mounting regulatory obstacles were most likely the reason for this termination. But it's just, Scott, it's really kind of crazy because last Wednesday on the earnings call, Adobe's management said they were, quote, excited about working with Figma. So this news today is a little bit of a surprise to some investors because of the positivity just last week. But we know the regulatory hurdles have been ongoing for quite some time. Morgan Stanley
They could still work
suggesting that
together.
Adobe's core fundamentals
They could still
are
work
on much
together, make
firmer
money from each
footing
other.
than when the deal was first announced back in 2022. Adobe demonstrating some gains with generative
kind of like
AI,
affiliate partner
also,
type thing.
more specifically with its Firefly machine learning model. So it may not need Figma as much as it did previously to drive growth. And then there's other positives from this deal failure. I don't want to say failure, but termination. Adobe would also avoid initial dilution in margins and earnings per share as well. So right now, Adobe's stuck paying about $1 billion in a breakup fee to Figma. But as Jeffrey says, it still leaves Adobe in strong footing, especially given their free cash flow.
He's a beast. So anyways, guys, appreciate you joining me here today. Thanks so much. This is a little bit of a short stream today. I had to get prepping a main channel video because we've got a lot to discuss in that one. And also save a little bit of energy for probably a Beast live stream tomorrow and potentially a Beast live stream Thursday. We'll see. We'll see about that one. But yeah, anyways, guys, appreciate you. Much love as always. Thanks so much for being here on a happy Monday. Hope you made some dang money out there today. If you didn't, what the heck's going on with your portfolio? Because you should have made at least a little bit today. Okay. All right, guys, appreciate you. Much love. See you on the main channel tonight, and then see you for maybe a Beast live stream tomorrow. Peace.